Welcome to the Asset Coach and Tax Strategist YouTube channel. If you're a subscriber, thanks so much for subscribing. If you're a first-time viewer, thank you for spending your time here with us. If you like our content, please give us a thumbs up. For you new folks, Asset Coach Tax Strategist YouTube channel is based on the book Economic Termites. This is a book that I wrote a few years ago talking about taxes, inflation, time, laws and regulations. Also, I wrote a second book called Farming Assets. Those two books is really what this whole channel is about, addressing those situations and how they affect you and I in our ability to grow our wealth. So as an asset coach and tax strategist, my name is Robert Wolf. I am the CEO and founder of Terra Firma Business and Financial Consultants and its affiliates. We have a bunch of companies that we've built out this ecosystem surrounding the basis of what we talk about on this YouTube channel. So if you're not a subscriber, hit that subscribe button. We drop episodes every Thursday. Again, if you are, thanks so much. And let's get into this next episode. So very excited about part 2 of California. So my first episode on this California part 1 was talking about, okay, they're the 4th largest economy in the world, blah, 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 right? But why? What's that look like? This episode is now talking about, okay, now if there started to be more of an exodus, if some of these companies started leaving California, what would occur? Because California right now hasn't driven them out just yet, but they will. Because that's their history. That's what they've done. They've done it with aerospace. They've done it with manufacturing. They've done it with agriculture. They've done it with Hollywood and entertainment. What's left is, here we go, and technology. And we've already seen a lot of companies leave California and shift into other states and started creating these tech hubs in other states, like Austin, Texas is one of those areas. But there's a lot of those little hubs around the country now, and it just makes more sense for these companies to do so. Again, California's weather, amazing. Other than that, what else do they have if they drive everything out? And so that's the real key. Now, are you going to have employees? Are you going to have talent that's going to be kicking and screaming? Well, probably yes. And the technology industry really has had, in Silicon Valley specifically, really has had a feeder system with the universities there. So, but a lot of the other universities are starting to compete. And they're starting to grow. And that's why these other tech hubs in some of these other areas are starting to thrive and grow. But at the end of the day, you don't need people with college graduate degrees to be able to be in the technology world. Okay, the technology is moving so quickly. I think this is an area that really is going to hurt California. And yes, I'm going to use AI like I have been to kind of determine what this looks like and what this effect is. I actually think it's probably be quicker. Once you have one of these companies leave, I think you'll have a couple of these companies leave. And the reality is that because they have to. They have to. California is already the most expensive state to live in. Their gas prices are highest. Their income taxes are highest. Sure, their property taxes are lower than some of the other states, but the property values are so high. And then just the cost of living is just ridiculous. And so at some point, these technology companies are going to stop giving away income, paying for staff, when they can go to the different areas of this country, have a lower cost of living in some of these areas, have the same talent and less expenses, and be able to drive revenue that way. Part of the problem is this kind of lottery winner type mentality where some of these companies are so successful. What do they always say in sports? You don't know a locker room has problems until they stop winning. And so a lot of these companies have been winning for so long by acquisition, by organic, whatever the case may be. But the moment that starts to slow down, we're going to start seeing some issues in the locker room. Okay, it happens all the time. And once that starts happening, it will start snowballing. And all of a sudden, California will start seeing more ghost towns, and we'll start seeing another exodus. And this time it's going to be different, but it's going to be a culmination of all the things that have occurred already. California has had multiple exoduses. Okay, the most recent one from 2020 to now really was due to politics, the cost of living and politics, and it just was finally people who didn't leave before were enough is enough. Okay, now there are a lot of people, obviously they're still hanging on, so to speak, but before 2020 was manufacturing. was a mass exodus out of manufacturing. They went to Southern Oregon, they went to Nevada, they went to Arizona, they went to Colorado, some of these other states, and they saw manufacturing increase because the cost of manufacturing was lower in those states. Okay, same thing's going to start happening. All right, so let me go ahead and let's kind of just dive into this and look at what this looks like. So, all right, so California's GDP. 4.1 trillion. What would this kind of long run structural effect, let's say 10 years or so, that would occur? So let's say Apple, just Apple, moves its headquarters out of California. What would occur? Well, let's say they move to Texas, right? Because that's where a handful of these have already gone, and it's kind of popular. You've got Austin, that's kind of a mini Silicon Valley. Not the same, right? But at the end of the day, it's evolving and developing. So let's say 0 to 3 years. Let's say that happens. Okay, executives, headquarter jobs, thousands of high income earners leave. All right, well, that's going to affect tax revenue for the state. Also, is going to affect property taxes now and property revenue. So, yes, let's say these people are able to sell their homes. Okay, but what's going to keep them there for the next level of sale? Because the reality is that when you have these high executive and high paying income jobs, what's also going to leave is the corporate services, right? So law firms, consultants, PR firms, events, that sort of stuff, they all end up following. California loses some of these corporate income tax. Now it starts creating more local spending, more issues, and the GDP impact to that really mainly loss of a headquarters, maybe $5 to $10 billion. Now, to us, that sounds like a lot, but when you're looking at, $4 trillion, that's really not a lot, right? That's cash in a wallet, right? That's not that big of a deal. But indirect on an annual impact compounded, that you're going to see about a 0.1 to 0.3%. Again, it's not really going to be visible on the GDP. Okay. Now, they stay the fourth. Okay, now let's look at the medium long term, 3 to 15 years. Now the real question is, does Apple also shift its R&D in major future investments out of state? And if that is the case, then that means that there's new campuses, Apple campuses for the staff and executives, for R&D. You got chip design, you got AI labs, that's going to be a big thing right now because the energy costs to drive these California is definitely not going to be the energy efficient state for that. And then manufacturing, which also California has driven out. So you're going to have a slow hiring in Silicon Valley, but you're going to have a more of a speed up outside of California. And let's say the GDP, it's gonna get closer to 1%. Okay, so now we're looking at anywhere from 20 to 40, $50 billion. Still, compared to 4 trillion, that's not a lot of money. But again, it's just kind of a ramp up. And again, if one company, you're going to start seeing other companies because you're going to start seeing the benefits, especially if your talent pool shifts. Now, what's this going to happen? You're going to have other spin-offs and startups that ex-employees are going to start creating. You're going to have the commercial real estate demand is going to drop, where Apple has been very dominant in helping in that. And remember all these other companies, all these other little ancillary companies in industry that help these large tech companies. Eventually, these large tech companies buy these little startups, but that's kind of the business model. So once that starts happening and it starts happening outside of California, you're going to start seeing that kind of snowball effect, so to speak. Now, will they be top 5 globally? Probably, yeah. Yeah, absolutely. I mean, it's assuming Germany and Japan still grow at the same pace, which is where they're right behind California. Okay, now let's go to scenario B. That was scenario A, just Apple. Now let's go to scenario B. What's this look like? Well, let's say all the top semiconductor firms decide to move. So you got Nvidia, Intel, Qualcomm, Broadcom, Lam Research, Applied Materials. Let's just say semiconductors say, you know what, we're out because of manufacturing, the cost of being in California, and they leave. So now semiconductors are a huge high value add, and it's really central to AI, as we know. Electronics, cloud, defense, auto, really everything falls and goes around this industry. Okay, and it's very, very heavy in R&D and capital expenses. So, so this inflow and these other again these other smaller kind of companies that start popping up around this infrastructure really is going to have a huge effect. So, if we look at this effect from a 0 to 3 years, what would happen if just the headquarters of these companies left California? And who cares where they go to? They just leave California. Similar pattern based on our scenario A. You're going to have these higher income positions leaving. You're going to start having these labs. You're going to have the R&D. You're going to have the design. They may linger a little bit, but they're eventually going to leave because of that. You're losing these high income jobs. You're going to be losing the suppliers for those high income jobs. Okay. Now, this may have about a 10 to $25 billion effect. Again, if we're just talking about the headquarters. Now, California stays at number 4. But then if we start looking at the long-term effect, really where it goes from 5 to 15 years, we're going to start seeing that it's going to kind of clustering of these labs and these fabrication and design hubs, like I said, kind of are going to follow. Right. So you're not just losing the today's GDP, you're going to be losing that future growth of the really that kind of compounding nest. So what would that look like? Well, you're probably looking at about 3% of GDP, which could be anywhere from 60 to $130 billion. Now we're starting to get in, a higher size, right? Now you have high skilled engineers. They're going to be leaving university industry. The partnerships with the university is going to start shifting and changing. So you're going to have some of these universities that have been very, very popular for this area are going to actually start budding up in other areas and really have already. They've been very, very competitive. But the key here is the startups that kind of linger. So, in nature, what's very interesting when you have some animals in nature have other animals that hang out to them. So you look at whales and they have these fish that eat the bacteria off the whales. You have some of these other safari animals where they have birds that do the same thing. This is the same thing. This is nature in itself. Nature in itself kind of clusters and bundles different things together and they work in unison. And so you're going to have these startups of chips going to be AI hardware, robotics, advances outside of California now in future industries that we don't even know exist today will be created outside of this area now. And that is really what's going to start affecting a lot of this as well as we start seeing this. So we're going to start seeing the weakening of these sectors and really this cloud infrastructure, hardware startups, these are all going to start shifting. And now you're going to see California shift to maybe number 5. Still impressive, right? Let's not argue that. It's still going to be impressive. But what's also going to happen, you're not going to see this right now, it's not just this area, but it's going to have effect in other areas. Because think about this. The entertainment industry is heavily based on technology now. You're going to start seeing that in the entertainment industry leaving as well. You're going to start seeing an effect on banking. You're going to see an effect not on just entertainment. You're going to see effective, or agriculture is going to be affected. Real estate is going to be affected. You're going to see a lot of the commercial real estate is going to be affected. And you're going to start seeing a lot of these defaults in the banking system is going to be affected because specifically in California, right? Because everything is growing and shifting into other states. Okay. Now, if really we see some of these other industries kind of following suit, the tech, the finance that I was talking about, we could see California go from 4 to 5 to even number 6. And again, kind of AI saying 5 to 15 years. And I believe that once you have one or two of these companies go, you will have a snowball effect. And I believe some of these other tech hubs are primed for this. I think they're ready for this. They're prepared for this, especially with some of these tax benefits and the various things that are provided. The reality is that it's going to affect California. So now that was scenario A, just Apple. Scenario B was more of these semiconductor companies. Let's look at scenario C. Entertainment. So Disney, Hollywood, they start relocating, which has already been happening. Okay. I don't know if you've ever paid attention, but there's a lot of Netflix series. There's a lot of Amazon Prime series. They're all really done in Georgia. And you look at some of these other kind of like Hallmark type shows and movies, most of those are done in Canada. Okay, so you're really starting to see this mass exodus already. Now, let's say Disney moves its headquarters and major decision centers. Okay, well, it's gonna really the production of entertainment. So let's say the production of entertainment starts shifting out of the state into other areas. Now you have kind of a Hollywood cluster where you have the studios, productions, the post production. You have these agencies. You have all these other companies that help in the production, such as equipment rental and the technology aspect. It just it could be pretty significant. Now, Disneyland's not going to up and move Disneyland, right? Disney's not going to take that away, but they certainly could rebuild somewhere else. Now, it's going to lose its lackluster and all that kind of stuff, right? But Orlando. Disney World has been pretty popular, right? So Disneyland compared to Disney World, it's completely different experiences. So short term, 0 to 3 years, what would that look like? Well, if you know you're going to have fewer location shoots, you're going to have spending. Now think about this as well. We have friends that are police officers in LA, and they do a lot of off-duty jobs such as security, that kind of stuff, which is for the for entertainment, whether it's for concerts, whether it's for filming during the weekends or whatever the case may be. These are all really important jobs that have an effect. So you'll see this, and you'll have this effect on tourism as well. It'll become less and less popular because tourism will eventually follow wherever that entertainment is going. Now, again, this is much smaller than technology, but this is part of the technology. Now, it may hit short term anywhere 5-15 billion. Again, it's not that big of a deal compared to the $4 trillion. But what ends up happening is the region of Southern California is going to be affected. And that's important. The region is going to be important. And so you're going to have excess. Now, the long-term effect, the 5 to 15 years, it's going to lose, California's going to lose the status of the kind of the global film and TV capital of the world, which I still believe, I think it's still happening because you have Atlanta, again, Georgia, you have Vancouver in Canada. Also, there's still a lot of filming in London, and these areas are going to capture some of this stuff that you're just not going to see in Southern California any longer. So what you're going to have this long-term erosion is really you're going to have a lot of this creative aspect. And again, this leads into the technology area and the semiconductors. When you have creativity, you have like minds, right? You're using technology, and that's going to start shifting stuff out. You're going to have the tourism that's going to be tied to this. It's going to start affecting that. And so you could see anywhere from 20 to $40 billion, really 1% of GDP leaving. That's not going to knock them off of their ranking of four. But along with technology, you can certainly see that happening, even if it wasn't the entire semiconductor industry. Now, let's look at a fourth scenario, D, finance and banking. Their headquarters, let's say to move to Texas or Florida. This would be like Wells Fargo and some other big asset managers, the fintech type stuff. Now, let's look at major players like Wells Fargo, Charles Schwab, which has already moved its headquarters. But let's say they start moving a lot of some of their other stuff from San Francisco, the venture capital out of Silicon Valley. Because if technology leaves, why do you need venture capital there? So that's going to move as well. So you're going to start seeing some of that erosion in the banking and investing area. Most big banks and headquarters have left. So let's look at 0 to 3 years. What's that's going to look like? Again, it's going to be high income executives, the legal, accounting, compliance, those more of those white collar office jobs. But those all trickle down into the rest of the local economy. But you're going to have now office space is going to be low, and you're going to start seeing some issues with some of these downtown areas. And you can't if you have these office spaces that are vacant and you're losing talent, you're losing people in the pool. Yeah, you can convert some of these high end office spaces to more residential. Who's going to invest in that? And B, where's the residential? Where if people are leaving more and more of the state because of these industries are leaving, who's going to be left? right? So finance is important, but California's primary engine really is technology. So it's really more focused on the financing within the technology, and you can see probably a $5 to $15 billion effect on the GDP. But again, just that alone is not going to affect California go from ranking 4 to lower. Okay. But this again, this is going to be clustering. You're going to start seeing this kind of snowball effect, and this is really a big thing. So now when we look at scenario at a long term where we're looking at 5 to 15 years, what could happen? Well, West Coast finance just dries up. Your venture capital, your private equity, because of technology, it's gonna flow out. Okay. And all of a sudden, you're going to see real estate valuations are going to go down. People aren't going to be able to sell their homes for what they bought it for. Okay. Now, California, again, I've said this before, has an advantage. China. Their advantage with China is that you have Chinese wealthy who cannot get their money out of China from a fiat type structure. So they'll have to buy actual physical real estate. So for a period of time, that will kind of prop up the real estate, which is what happened with the COVID period of time. That's why so many people, when they were able to leave California, they had cash buyers. They were able to leave and come to states like Texas or Idaho and be able to pay cash for a house and still have tons of cash left over because of that. So, what's going to happen with tech, semiconductor, entertainment, real estate, professional services when they dominate, but they leave? And you're going to have this 1%. We're talking about, when we add a lot of this up, you're talking about really a huge chunk leaving California. If all of this happens, and I believe that you got a snowball effect where all of this is going to happen, I believe it's going to have an effect from anywhere from 500 billion to actually a trillion in their GDP. Now, I think this is about a 10-year. We could see this being affected. Now, we have inflation that is also part of this, that's also holding this stand pat. But inflation affects everybody. So let's say they stay at the 4 trillion. That still may not keep them at number 4. That may drop them to 7, 8, 10 in the world ranking, because all of this exodus and the inflation and the increased value of all these industries that are occurring in these other areas certainly can reduce. Now, when they leave California, do they go to other states? And does that take the focus and spreads that wealth, that the GDP, to other states and other areas? Absolutely. So what would have to affect is that really California's GDP ends up being lower than other countries like Japan, Germany, and you see them start dropping farther and farther. Okay. Now the competitors could be Texas. I doubt people are going to leave California to go to New York. So you can see Texas and really Florida. Those are the two main ones that I can see that will be picking up their GDP, that can replace California and or New York in this GDP growth area. That really has that most effective. But again, if California leaves, they see this shrinkage, it's going to be more of some other countries rather than states that are going to replace that. But Texas, for example, they're about $2 trillion. So it's a significant difference. But again, if you have this flip-flop and you've already had some tech companies and entertainment companies, you've already had some finance companies leave for Texas. If you keep seeing that exodus and you see a lot of this stuff happening in Texas, you could start seeing Texas, their GDP increasing. Do I think that's good for Texas? I actually really don't. And the reason why I don't is because I think it now becomes a California 2.0, so to speak. We've already seen Colorado have this kind of scenario, if you will, and that's affected them quite a bit. But anyways, so that's my thoughts on this. Again, this is my thoughts. This is my opinion. My thoughts and opinion with ChatGPT, kind of looking at this and seeing what this looks like, and just kind of sprinkling in some my opinion and thoughts and narration into this whole dialogue and conversation. If anything, it's an interesting conversation because the history of California, if you think about it, if they didn't drive out all these other industries, California, like I've said before, really could be the second largest economy behind the United States. It could surpass China. But they haven't. They've made these political decisions. They've driven out a lot of these other industries, which has been beneficial for the United States as a whole and some of these other states and this migration out of California. So that's been beneficial from that standpoint. But anyways, so if you like this content, give us a thumbs up. Add any comments down below. If you haven't subscribed yet, go ahead and hit that subscribe button. And I appreciate you spending and investing your time here. Go make it a great day.